Alright guys, welcome back to MMGinvest and WolfPack Cryptos. In today's video, there's just a lot to cover. I'm going to cover some of the price, I'm going to cover some news events. There's a lot going on economically and with the stock market and with gold, silver, and whatnot. This is not financial advice. Consult your financial advisor. I am not your financial advisor. Stocks, cryptocurrencies, everything. It's extremely volatile, extremely risky. Do not invest in anything you're not willing to lose or lose sleep over. Have your stops in, emotions out. This is more of an educational channel. Come over to MMGinvest, my other YouTube channel. Here it is. You just type in MMGinvest and you're going to find it. It's the gold line. Alright guys. So, the Three Stooges, I'm talking about Jerome Powell, Ben Bernanke, and Janet Yellen, are going tomorrow around 10 a.m. U.S. Eastern Standard Time. They're going to have a panel. And this is going to be watched. Because the stock market's falling again. The Dow Jones fell 677 points. But the Three Stooges are going to come on all together. And they're going to give us their opinions. Now, guys, don't forget that Janet Yellen, right before she handed over, or actually, yeah, right before she handed over her Fed chairman's seat to Jerome Powell, she said, "We will not see a recession in our lifetimes." Now, after she handed it over, she actually came out a few months ago and said, "We're going to have a recession." I mean, you can't make this up. It's just, it's funny. It's not funny, but it's funny. I mean, this is how dumb these people are. Or they're just lying. And I think they're just lying. They have to know. So Apple crashed. I'll look at the charts. Trump considering Democrat Senator Webb for Defense Secretary. That's weird. The liberals and Nancy Pelosi took control of the House today, and they're already going at it. So that's not good for the economy. Pocahontas is running for president. That's good for Trump if she's the main competitor. And there's just a lot going on. Just a lot of bad things. Now, these talking heads on CNBC, they're so stupid. It's like they're just figuring things out. They're actually starting to say the word recession. And they're also blaming this on China's economy and their stock market. Let's take a look at China. Where is it? Here's the Shanghai Composite monthly chart. Every candlestick's a month. Look at this. I mean, this is China's in a recession. I mean, their stock market already pretty much crashed. This would look like 2008 for the U.S. So they had a huge boom in the early 2000s, right? Huge boom. Their economy was growing over 10% like every year. Crashed with the United States in 2008. Then it traded sideways, slightly down. This was a nice pennant. And broke out for, when did it break out? In 2014, it broke out again. And they reinflated their bubble and their commercial real estate, and they started building ghost cities. And it crashed again. And now, since December of 2017, right after, well, no, I mean, yeah, the end of 2017, Trump and the tariff wars and whatnot has helped crash their economy further, but it was going to crash either way. And the talking heads on mainstream media, they're like, well, this is because of the trade war, and China is taking down Apple, and Apple's taking down the S&P 500, and blah, blah, blah. Yeah, that adds to it because China is intertwined with the United States economy more than it should be, and you could blame the past like 3 presidents for that, right? And they've gutted the United States of its industrial jobs and created and turned the United States into a consumption-based economy driven on money printing and debt. All right, so yeah, I mean China is done. Look at this. It is on major support, and I'm assuming it's gonna bounce off of this major support for the Shanghai and trade sideways probably for a very long time and then crash some more eventually someday. All right, for the long term. But this is a monthly chart, so I'm looking at like 2 decades here. But it's on major support. It's already tanked. What else did I want to show you guys? There's just so much going on. This is going to be random. Alright, so Tom Lee. I don't want to click on this. I don't want to get another copyright strike. Tom Lee, you know who Tom Lee is. He was calling for the end of 2018, 15,000 Bitcoin. He's a huge analyst on CNBC. And I posted this in the newsroom of WolfPack Cryptos and MMGinvest. Which I should make a newsroom for MMGinvest, but I don't know. There's not that many people in there. Where is it? Yeah, here we go. You guys could click on it and listen to it. It's funny because I didn't catch it with my phone when I was recording, but they called him out. They're like, weren't you calling for 10% higher than all-time highs by the end of this year for the stock market? And he's like, oh, well, yeah, but, and he was wrong about that, just like he was wrong about Bitcoin. But he is right about the Fed popping its own bubble. Of course, the way he says it is, it's for mainstream media, and he's saying that the Fed raising rates has popped their own bubble. And you guys could click on that. It's like a minute-long video. It'll be in the Telegram chat rooms, the free ones. Links are below this video. Alright, what else is going on? I will talk about the Treasury yield inverting and its continuation of inversion. It was flattened out just a few weeks ago. Alright, so Trump, more people wanting to come here due to strong economy. He's talking about his wall. And I've said this, guys. That wall is going to keep U.S. citizens in once this economy implodes. And Mexicans aren't going to want to come here. That's just the truth, alright? And he came out, he gave a speech today. Trump, we are doing so well with the economy. Not according to the some economic data that came out today, which caused the sell-off. All right. By the way, I was stopped out of the Russell 2000 and the E-mini Nasdaq futures. I was stopped out. I posted that earlier because I did buy in. I'll show you guys the charts. There's so much going on. I have to scroll through this. Stock slide after FDIC reinsures that banks are superbly capitalized. So, so the FDIC insurance, right? They came out and they're saying, guys, don't worry, the banks are fully capitalized. They're not going to go under. Of course, that's going to cause a panic. Why else would they say that if they're not worried about the banks going under in the first place? I mean, these people are retarded. And what have I said about the FDIC insurance? The money's not there, guys. Whatever you deposit in the bank is the bank's liability because they lend it out or they buy stocks with it. Now the stock market's crashing and people aren't going to be able to pay back all the loans the banks put out into the economy. And then the banks go under. And then you have a run on the banks and the FDIC insurance cannot pay it out. Or they can, but then the Federal Reserve is going to have to print trillions and trillions of dollars. So you might get your money in the bank that you deposited, but it's going to take like a 30% haircut, something big in value because of inflation, because of the money they have to print to re-liquefy and recapitalize the banks that just went under. I mean, you don't have to be a rocket scientist, guys. All right, so NASDAQ on pace to break 5-day winning streak. Well, that 5-day winning streak, I made some decent profits. I traded that for a swing trade. If you guys remember, I bought in like last week or a week ago. But I did get stopped out this morning. Dow Jones dropped 677 points. Yeah, here I posted I was stopped out, took profits from my ETFs. And then here is the NASDAQ E-mini 100 and the Russell 2000 on the right. I bought that dip all the way down here and down here on this momentum trade. So you had to have been there for the momentum trade. So what else is going on? Bond yields fall, dollar weakens after biggest ISM manufacturing slump. Alright, so the ISM manufacturing report. So manufacturing, guys, what have I said about manufacturing? It's not doing that great, even though Trump keeps talking about the great economy. The ISM report came out today. I mean, manufacturing jobs, we're still losing manufacturing jobs. The trade deficit is still rising, and the tariff wars, you know, aren't working because nobody wins a tariff war, although he is crashing China pretty well. So, yeah, I mean, I don't know what else to say. Not just that, the manufacturing we have right now, which is around 10% of the economy for the United States, it's like, that's also pumped up with this giant stock market bubble, guys. All right? So that's good. So manufacturing is going to suffer either way. I mean, and the only thing that could save people in the United States from starving to death is probably jobs and manufacturing jobs. You might not get paid a lot. It might not even pay the bills, but you might be able to buy food. But if we can't even have manufacturing jobs and we can't even sustain ourselves and build things for ourselves, that's why this is gonna be horrendous. And I honestly don't want that wall built, because just in case I want to toss on that bug out bag and run south of the border. I mean, I'm joking, I'm laughing, but it's really not. It's that bad. All right, but don't worry. I mean, the stock market, it'll probably take a couple years to keep falling and fully implode. All right, so, and you know, no one should complain. I said this was going to be a dead cat bounce. Here's S&P 500 daily chart. Dead cat bounce. This is what dead cat bounce is. Huge drop, crash, then it bounces, and then the bounce. It's a bounce because it sells off. It's not sustained. Now, I was hoping that this bounce would sort of be a rebound back up into this major support area where the crash started really occurring, and which is the bottom of this descending giant triangle from the all-time high in the S&P 500. I was hoping we would get up into this range, so I would have a way more profitable swing trade with the Russell and the NASDAQ and some ETFs. That didn't even happen, and this is how weak things are. This is how weak the fundamentals are. This is how bad it is with the Federal Reserve not being dovish enough and popping its own credit bubble. So that's how bad things are, guys. I mean, I didn't think this would sell off this quickly. I thought it would get a little higher. At least up near closer to 2,600 on the S&P 500, but this is bad. This is really bad. So technically, looking at technicals, charting, right, technical analysis, this means shit's really hitting the fan and we are going into recession. Now, the fact that the stock market from the all-time high fell 20%, that already indicates recession, but we bounced off that 20% not dip, but correction, and now we're heading back towards the 20%. And once it falls below 20% again for a second time, it is official. Even mainstream media has to admit we are in a recession, we are in a bear market. Okay? But man, did I call this? I called this. Listen, when we fell from the all-time high and we were around these prices, around 2,700 on the S&P 500, I was already calling that the top is in. and I put this arrow and this air in. I mean, you guys could back test me and look at my videos from 2-3 months ago. I was already saying the top is in when we were still up here with the price, and all of this hasn't happened yet. So I'm better than, who am I better than? I am better than, now I'm starting to sound cocky. I'm better than Warren Buffett. So, you know, Warren Buffett, he like didn't see the 2008 mortgage-backed security crisis coming either. But he got lucky because they printed money, and then we crawled back out of it in 2009, 2010, and 11. But you guys have to understand with Warren Buffett, he doesn't buy the stocks you buy. He buys preferred stocks because he buys them in bulk, and he has so much power and weight within the market. So when Warren Buffett comes in and buys a company's stock, the company gives him privileges like high-yielding dividends, preferred stock with high-yielding dividends, which your average investor can't get. So even when the shares of a stock really fall, it doesn't matter to him as much, or it's not as painful to him as much, because he gets huge yielding dividends. And that's what, because he's a whale. I mean, he's the biggest whale. He's like Moby Dick in the market, right? So he gets preferred stock because he puts in. He's like, for you crypto people, he's like your whale of last hodler of your last hodler of resort. The whale that sits and holds so the thing doesn't fully implode. All right, if that makes sense. All right, so here's S&P 500. Technically, this looks like shit. I mean, I'm out. I'm not buying any more stocks. If anything, I'm looking to short. Disclaimer, I do have a short on Tesla. Apple, I do not have a short on. I took my short. I took profits from my FANG stocks short. I might go put on another short. I don't know. I don't want to make these calls too public because I'm really overwhelmed with all the work I have to do with cryptos, equities, and finishing my MMGinvest research report portfolio and trading academy, which is like, I really want to launch that next Monday. It's just, guys, I'm not gonna hire someone $5,000 to build me a website, and it doesn't look like the way I want it to look. It doesn't function the way I want it to function. I pretty much have the website built. It's like built 95%. I just have to add crypto payment options to it, and I have to finish the report. The report is what's really time consuming. But don't worry, I'll talk about gold prices, and I'll talk about if they're gonna pull back. Yeah, so the S&P right now, I wouldn't be surprised if we test the 2400 support again. Now there is that panel tomorrow with the central bankers and former central bankers talking about the economy, and Powell is probably going to capitulate and be really dovish, and he's going to say, all right, well, we will stop raising rates because this looks really bad with the markets, and that might help shoot the stock market back up tomorrow. I don't know. We'll see. But at the same time, like I've said, if Powell capitulates, that means that we're going into recession, and the Federal Reserve has to capitulate to stop the stock market from going into recession. But you know, investors and traders aren't stupid. Then they're going to wake up to the fact that this is a bubble fueled by money printing. There was no real economic growth. Although I don't think they've come to that conclusion fully, but they're getting there real quickly. And yeah. Here's the dollar. So I had that cup and handle, right? And the dollar did spike today. And the dollar is acting as a safe haven, or when they sell stocks, they go back into dollars, and then it'll cause the dollar to shoot up. And guys, I've said this before, I would not be surprised if we get a bull market in the US dollar and a bull market in gold at the same time. It's happened in the past. And it all depends on how bad China and Europe is fully imploding prior to the US. The 10-year Treasury yield. Look at this. Man, it's falling off a cliff. The bond market, this is pretty volatile, guys. I'll talk about the yield curve in a second. I don't see any patterns. Let's go to a monthly real quick. I mean, here's the thing. The bond market wants higher yields because historically normalized yields is right back up around 8%. That's normal. This is very not normal. This is artificially low because of the central bank lowering yields, the interest rate on US debt, and yeah, the interest rate on all debt in the economy. But the central bank is going to try to lower its federal funds rate, and that's why it's falling lately, because they're pricing it in ahead of time. So we might see something like this. I mean, this is just my opinion. I'm just drawing. I wouldn't, I'm just saying, I doubt there's any bond traders listening to me, but who knows. I wouldn't be surprised if the 10-year yield drops a little more, and then eventually, when things start really unraveling, the market's going to push up yields if the Fed likes it or not, and it'll go back into a bull market, and that will be the Great Depression and hyperinflationary depression. But I mean, it's hard to say, because if yields rise, it should stop inflation, but at the same time, they're going to print so much money, we're going to get inflation either way if the yields rise. I mean, the yields would have to rise all the way up here for the inflation to be capped. But at that point, every business has pretty much gone out of business. The U.S. government, federal government, has fallen apart and has to literally lay everyone off who's a federal employee. And including the states, all your pensions, Social Security, everything's just completely wiped out by the time interest rates are back up here. So let's take a look at Apple. I wanted to look at Apple. So look at my indicator, which comes free, by the way, for the WolfPack Cryptos private members. And it will come free for the MMGinvest report, which is coming soon. And this thing, I mean, this indicator is solid, guys. Look at this. I have a 9 sell right at the top, all-time high on Apple stock. I mean, look at these buys, these 13 buys. Let me zoom in. Look at this 9 buy signal right here. Look at this rally. It's beautiful. Look at this 13 buy. Price flip, buy. Look at that. Sell, it dipped. Look at this 9 buy signal down here. This green 9. Huge rally right afterwards. 9 buy signal right here, green. Huge rally. 9 sell. Huge sell off. I mean, I should have been trading Apple. Leveraged. And I haven't. Alright, so Apple really took a dump today because their revenue is their forecasts, and they're missing revenue reports, right? And Apple is like one of the largest FANG stocks, and the entire S&P 500 and like literally the US economy is like based off of like Apple and these huge, and Amazon, like these huge companies. Now Apple is a real company which makes real products. But they also sell in China, and nobody's buying Apple phones in China. And probably U.S. customers probably can't afford Apple as much as they used to. Now look at this gap. Huge gap. It's hilarious. I mean, huge gap. Look at this gap. There's nothing in there. It's just air. It just fell. It's like a bowling ball falling off a table. It's huge gap down. It is on major support. right here, so I wouldn't be surprised if it does bounce tomorrow. But man, did it gap down. And that's just another red flag for the U.S. economy. And this would have been a beautiful short. I did short FANG stocks, but I wasn't shorting Apple. I should have shorted Apple. Look at this. All-time high of Apple was $233. And right now it's at $142. Beautiful short. Beautiful. Look at this. The moving averages. Little death cross right here. With 50-day and 100-day. So the 50-day moving average crossed the 100-day. Beautiful short. I'm just curious on the weekly. Whew. On the weekly, it's already fell below the 100-week moving average. That's bad. 200-week moving average is coming up at around 116 bucks. That's freaking nuts. All right, let's take a look at gold stocks. Let's talk about gold. I know you guys want to talk about gold, or maybe you don't because you want my research report. You guys are FOMOing. Here's a bunch of gold ETFs. I'm not saying to buy these. Some of these are not what you want to buy because there's better ones to buy. Let's take a look at a few things here. Alright, so here's the gold stocks that I look at, right? I'm not saying all these are in my portfolio, but you can't see the names anyways, because this is what I'm going to be doing research on, right? That I'm selling in like a week. So some of these gold stocks on today are up. I mean, there's one here, it's up like 9%. Here's another one up 9%. On average, they're up around 6, 7, 8%. They're performing pretty well on the day. Today was a big day for gold junior miners, large caps, and even micro caps. They actually started rallying today. Here's one, 20%. 20% on today. Today it rallied 20%. This one, 11%. Another 6%, another 9%. I mean, they're doing pretty good right now. My portfolio overall rallied like 40% in the past few weeks. So, I mean, another 10%, 11%. There's a lot of 10% baggers for just today alone. So, why am I showing you that? Well, one, gold is definitely the safe haven asset, and it's definitely going to benefit from the stock market crashing. It hasn't taken off like a rocket just yet, guys, but it is starting to take off. Look at these ETFs. These are massive gains right now. And I did buy in, right? Like, I don't remember, a few weeks ago, a month ago, something like that. I bought down here. I bought literally the bottom here on these ETFs. Well, not on all of them, but on some of them. Well, the daily junior gold miners, the Direxion, 3x leverage junior gold mine. I did buy that at $6 because I trade that a lot. So disclaimer, and it's up $4. It's up over $4. So it's up 40%, right? So when the smaller gold mining stocks start taking off, that does signal that gold is going to keep going higher. And that's from experience because I've been trading gold and silver for many years. So we're gonna see if gold could break out. Now, I did say in my last video, I don't think it's gonna break out. I think it's gonna pull back. So here's gold futures. This is a weekly chart of gold futures. It's coming up on resistance at 1300. On the weekly, it is on a 5 count. So there is 6, 7, 8, 9. There's still another month of possible upside to this rally. All the way up to 1,360 on gold. At 1,360 on gold, there's another major resistance, and then it could pull back from there as well. But right now, we haven't broken through the 1,300 resistance. Not yet, but it could happen tonight, tomorrow, by the end of this week, right? We're at 1,296 pretty much right now, currently. And there was a short squeeze indication right here, and that's why it also broke out. RSI, it's you know, it's up there, it's overbought. MACD, it's still trending up. Let's take a look at the monthly if that tells us anything. So on the monthly, we're just on a 2 count. So the 3 count could temporarily break through 1,300 and then pull back. And then the 3 could break down and it'll be a false breakout. And then we're going to fall back down towards 1,230. And that's what I want to see, because I want another buying opportunity on these gold stocks and silver stocks. You can see my indicator right here, my TDI. It gave me a perfect 13 buy signal. I know it's red, but it should be green. Or no, well, it doesn't matter. Don't look at the colors. The 13, we had a 13 count to the downside. Perfect rally right afterwards. The price usually rallies after you finish a 13 or a 9 count, right? And it worked out really well. This is a monthly chart. Every candlestick's a month and this is gold futures. Just a reminder. So 9 right here at a nice 9 sell, and look at this candle, inverse hammer, and then the huge drop. Perfect for trading. Perfect. All right, guys. So let's take a look at the daily on gold. So I did, on my last video, I did say there was a 9 count coming up on the daily, and I expect a pullback. Well, you know what? I didn't get stopped out, so I didn't sell either. And I know I talked about selling, but I just moved my stop higher and my stop never got hit. And I'm still in this gold trade currently. So this 9 sell, it didn't work out. And they don't always work out. And the price just kept going higher. This is pretty much FOMO at this point. People are FOMOing. Although my heat map is telling me to take profits right now. So, and look at the RSI on the daily. Extremely overbought. Actually, this is the momentum indicator. Here's the TM squeeze. It's pulling back. So I do expect a pullback on gold. Now, I know the gold miners, the gold mining stocks are telling me that it's not going to pull back and it's going to keep going higher. But listen, guys, with my experience, they're going to manipulate it. They're going to slam it down. That's what they always do. The banks are going to come in and short the crap out of it. They can't let gold get too high. They don't want to see gold break through 1,300. Now listen, once gold breaks through 13... let me go to a monthly so I can show you, so you can see it. Here's gold, monthly chart. Look at this huge bull run since 2001. You would have made a killing. Anyone who says you don't make money with gold because it doesn't yield any dividends, I don't give a shit. Look at this. It went from $250 in 2001 to almost $2,000. So the gold bugs have been doing great for the past 2 decades. All right. So once the price breaks above 1,000, I know I've said 1,380 to be conservative, which is up here. But honestly, once the price gets up to 1,360, we're going back into a bull market. It might pull back to 1,300, and then it's going to freaking take off. And we're going to go to all-time highs probably rather quickly in the next year, 2 years, 3 years. And your gold mining and silver stocks are going to see like 1,000% gains, if not more, on some of these small macro ones, micro cap gold silver stocks. All right, guys. But as of right now, let me go back. I do expect a pullback on the short term. I mean, the price could still keep rising for the next week, but I'm expecting a pullback, and there will be support around 1,230, and that will probably be your. That's gonna be. I'm gonna say that's might be one of your last best buying opportunities when gold goes back to 1,230. All right. Now looking at these ETFs, I mean, same with the ETFs. They're coming up on major resistance. A lot of them, they're coming up on moving averages. So we'll see if we get a shooting star, and the shooting star, I mean, is one of the can't here. Here's a shooting star. You see this huge wick? The price shot up to this moving average, and then everyone took profits, and it created this huge selling wick. And then the price, closed the day down here at the top of this body of the candle, and then a huge sell-off. Well, I'm expecting this candle to possibly end up looking like this candle right here, and if it does, the price is going to shoot all the way back down on this ETF, and the same will go with the gold futures. All right, guys. So, am I forgetting anything? Oh yeah, the yield curve. All right. Well, here's a dynamic yield curve. I've shown this a few times. Here's the right before the 2008 mortgage-backed security crisis and recession. Hey, stick around for 5 more minutes. I'm going to show you another yield curve chart. And then right before 2008, look at the yield curve. All right, so this is normal. This on the left here. When it looks like this is normal. When it starts flattening out like that, that's indicating a recession coming. It inverts just like this. The short-term yield on government debt is higher than the long-term government debt. Then it signals a recession in like 6 to 9 to 18 months from now. And then guess what happens? Boom. The yield curve normalizes, but while it normalizes, this blue line on the right here is the stock market, and the stock market crashes. All right, where are we right now? So here's 2010, 2011, 2012, 2013, 2014, 15, 16, 17, 18, starting to flatten. End of 2018, it's really flattened out, and this is where we are right now. It's trying to invert. It's not a full-blown inversion, but it's trying. It is artificially pegged down below 3% though, so keep that in mind. But once the 2-year and like the 5-year are higher than the 10-year and the 30-year, I mean, that's full-blown inversion. Here's another yield curve chart. So an inverted curve has predicted the past 7 recessions. So where are we right now with the yield curve? Here's 1980s. You can see that the yield curve, once it falls below this red line, indicates a recession. So you see this darkened area, this darkened bar area, that's a recession. And then the yield curve prior to the recession fell to this red line and below, and then we had a recession. Same goes right here, right? Here's the 2000 yield curve, right? It fell below the red line, 0%, and we had the Nasdaq.com bubble burst. You see this tanned area right here? Can I blow this up? No, I cannot. Maybe I could blow this up. Give me a second. It's not downloading. Whatever. I mean, you guys can see it. Yeah, you guys see it fine. All right, and then here's the 2008-2009 recession, right? This darkened in area. Here's the yield curve. It's falling. Well, it's inverting. This blue line is showing that it's inverting. It's not falling. And then it fell below the red line. and then we had the recession, right? Well, right now, we are right at the red line. That's where we are at right now. Right at the red line. Alright, guys, I just wanted to show you that. Here's the 10-year and the 2-year spread. Same thing. Oh, that's what this shows. It's the spread between the yields. I don't want to get into it. I don't want to make this video too long. You can see we're right at the red line. So the spread between the 2-year and the 10-year. The spread is the yield, the interest rate between the 2-year and the 10-year. When the spread comes together and the 2-year interest rate is higher than the 10-year, that's an inverted yield curve, and that's the spread. And guess we're right at the red line, and we're about to go negative on the red line, or the 2-year yield is going to go higher than the 10-year yield. And guess what happens after that? This darkened area, recession. That's what this is all signaling, guys. Believe me, the Fed knows. They have to know. They have to see this. You can see, look at this interactive yield curve. Treasury yield curve. Look at that. This yellow line is on the chart. It's showing you the stock market. So the S&P 500 is the blue line. The 1-year constant maturity rate is the black line. The 10-year constant maturity rate is the green line. So the 1-year and the 10-year. And the maturity rate, the interest, the yield on those bonds that are 1-year or 10-year. You can see the yield curve inversion on the left here. See that? Look at that. That's right before 1990 or 2000. Or no, that was like 1991. It's coming up on the year 2000 right now. Check out the yield curve before the Nasdaq.com bubble. And boom, inverted. Had a recession. We're about to come up on 2008 right now. Look at the yield curve. Boom, inverted. Had a recession. What is it about to do right now? So this is normalized. Alright, we're coming up on 2016, 2017, 2018, and this is where we are at right now. It hasn't fully inverted, but check out this 1-year yield. It's higher than the 5-year. It's in line with the 7-year. The 10-year, it's not quite above it, but it's almost there. Because the yield on the 10-year is 2.69. Yield on the 1-year is at 2.63. Now the yield on the 1 month, I mean, that's artificially pegged to the federal funds rate, which is controlled by the Federal Reserve. Alright, guys. Found this video informative, interesting. If you liked it, if you want me to make more, smash that like, subscribe, and check us out. The links are below this video. There's free chat rooms where I keep you guys updated with news, my thoughts, opinions, and then stand by. My research portfolio is coming for gold and silver, mining stocks, and the economy, and trading academy, and indicators. I'm going to give away indicators that are like $250 a pop. I'm going to give away like 10 of them in the end. I don't know. I don't know if I'm going to give them all away. I don't want to give away the ones I use that nobody uses. Alright, guys, until next time.